we have three really great panelists that will be talking through on some really unique ownership pathways. But just as a quick intro to what they're going to talk about, so as Hughes mentioned, my name is Sarah Kay. I lead the philanthropy and community engagement programs at Prudential. Prudential was founded 149 years ago in Newark, New Jersey, because our founder, John Dryden, he saw a societal need out there that working class families didn't have the financial means to bury their loved ones. And so our first product was burial insurance. It cost as little as 3 to 5 cents a week. And with that product, he disrupted a marketplace because at that time, insurance companies didn't think that working class families could be trusted to pay their premiums. And so it's in the DNA of our company to really look at that intersection of both societal and business impact. And so the company's mission is to ensure that everyone has the opportunity to achieve financial security and ultimately prosperity. In our philanthropy, we focus on how do we advance inclusive economic growth in cities, how do we build inclusive wealth building pathways, which we'll talk about today, and how do we strengthen nonprofit organizations to be able to provide more better and deeper services and programs, and how do you scale that work? Today we're highlighting three organizations that's really working to build an ownership economy where everybody has the opportunity to build and then pass on wealth. Ownership and asset ownership in particular is key to wealth creation. We know that ownership is about the accrual of equity and building wealth over time. It could be leveraged to buy a home, to buy or start a small business, to invest in education, and more. Ownership allows people to have control and choice over their lives. And so how do we enable all of that large-scale wealth building? We know all the stats out there, but I'm just going to reiterate a few of them. We know that the income and wealth inequality in this country is ever growing. There are far too many families stuck in the cycle of intergenerational poverty because there aren't access to pathways to build that wealth. The top 1% of American earners control more wealth than the entire middle class in this country, and the bottom 20% own just 3% of the country's wealth. And the racial wealth gap is even worse. The median wealth of a white household is over $250,000, while the median wealth of a black household is just over $24,000. So that's 10 times more wealth between a white and a black household. So with those stats in mind, I'm going to turn it to our panelists. We have Trevor Rozier-Boyd, who's the founder and CEO of Stackwell. We have Stacy Smith, who's the Senior Vice President and Head of Programs at Project Equity. And then Hope Wolensack, who is the founding executive director of the Georgia Resilience and Opportunity Fund, or the GROW Fund in terms of its acronym. So I'm going to first start with the purpose of why you guys are doing this work. And so you guys have all dedicated your lives to building wealth, particularly for low-income communities, specifically communities of color. And so if you can each just share a little bit about the purpose of why you're doing this work before we get to the actual solutions.
Well, thank you for having us here today. Excited to be with you all in this space and having this conversation, and certainly Sarah and Prudential for giving us this platform. I'm drawn to this work because, very basically, I think all individuals, communities, families need wealth in order to thrive. My background, I was a corporate transactional lawyer to start my career, spent some time on the business side in corporate development, corporate strategy, always in finance and asset management. I helped build a lot of wealth for a lot of people that don't look like many of us in this room today. And what I drew from those experiences was that it didn't actually require as much knowledge and education or access to capital as most people think to actually participate in the public financial markets and utilize them to help grow and amass more wealth. And I felt that there was a very deep need to create access to a platform and a sustainable pathway for more people in historically underrepresented communities to start to participate, to gain knowledge and confidence in the process, but also be in a space where they could develop the behaviors that would allow them to persist in the process and ultimately build long-term generational wealth that would benefit themselves and their families and their communities for years to come. So that's what it was about for me. Obviously a lot more to it, but looking forward to getting into it in the conversation.
Hi, everyone. I'm so happy to be here, and I want to thank Sarah and Prudential for hosting this session. Let's see, it's such an interesting question. My career has had a lot of twists and turns, and I find myself working in this space now, and it's really kind of the culmination of many things that have happened in the past for me. I grew up believing in the promise of capitalism. I came to understand that capitalism is really broken in many ways. I spent decades working in the field of corporate sustainability and corporate responsibility, and there was never a great solution to look at community impact and community wealth and economic development in that framework. And I was introduced, I work in the field of employee ownership specifically, and I was introduced to that several years ago, and it was like a giant light bulb went off in my head, and I was like, that's it. That's exactly how we address economic development and workforce development and community impact in a positive way through the private sector. So we in particular very much look at the intersectionality of owning equity in your workplace and looking at that for low to moderate income folks and folks of color. And it is a powerful model. It is exciting as all get out when these folks have ownership of the business that they have been working in for a long time, and they suddenly have pathways to access other capital and access other means of creating wealth for themselves. So thrilled to be here to talk about it, and thrilled to be working in this space alongside you all.
Hi, everyone. I'm Hope Wolensack, founder and executive director of the Grow Fund, and I started my career as a teacher and assistant principal in New Orleans, Louisiana. I very quickly learned that although education is incredibly important, it is only one of the factors that contributes to young people's success. Really, when I was teaching kids day in and day out, I saw that they were grappling with much deeper economic issues that were determining their access to opportunity, to life, to a thriving future in ways that were really dependent on resources and access to resources. So what really brings me to this work is thinking about what can we do to change the underlying conditions to ensure all of us have the bedrock of financial security, and included in that is access to wealth building opportunities, and ownership plays a huge role. I transitioned from my work in education to have a deeper impact and started the Grow Fund just about 4 years ago, and we focus really on economic security work via guaranteed income and also emerging baby bonds work, which we'll get into more today. But I think a lot about how our life, opportunity, and communities can thrive when those young folks are coming to school with the school supplies that they need, when they're coming to school well-rested because they have a stable place to live, when they're coming to school with their bellies full and ready to learn. How does our world look fundamentally different, and what opportunities can we collectively achieve under those set of circumstances? So they are really what brings me to this work, and excited to get more into it with you all.
Great, thank you. So as some of you guys saw in the description of this session, this is focused on building an ownership economy, and most people think automatically about home ownership, which is an incredible important pathway. But as Trevor, Stacy, and Hope mentioned, we're today going to talk about employee ownership, financial asset ownership. And so for each of you guys now, can you talk about what's the challenge that you're trying to tackle, what's the solution that you've created, and what's the progress to date?
So the challenge that we're trying to tackle at Stackwell is increased ownership of financial assets by historically underrepresented people, more specifically individuals in Black and brown communities. So you take a step back from that problem statement. The reason why we do this work is because when you look at asset ownership of Black and brown families going all the way back to 1950, about 70% of their assets are held in housing and other non-financial assets, as compared to around 40% for white families in this country. Asset ownership of investment in the stock market is around 7% for Black families historically, and nearly 20% for white families. And that's important because between 1950 and 2019, the growth in assets in the stock market have outpaced real estate and non-financial assets by 5x. You fast forward that to what has transpired since the beginning of the pandemic, we know that there is about a 30% increase in the gap in wealth between Black and white families in this country from 2019 to 2023, largely attributable by performance of the stock market. And when you look at the performance of the stock market over the last decade, it's up about 155%, 24% in the last year. And the reason why all of those data points matter is because even to this day in 2024, there's only about 40% of black families that are invested in the market. So all of the known historical reasons why there's a gap in this country are in fact true and still prevalent today, but I think that the lack of participation in the financial markets has contributed to the expansion of that gap. And what we are trying to do at Stackwell is, first and foremost, create a sense of representation in this space for people that have historically thought that it was not for them, that it was something that only older white males could do, and start to show them a pathway towards building the knowledge and confidence to actually participate. So we offer people through our app access to model investment portfolios. We get them into the market using broad-based indexed ETFs, which we know are the most powerful way for any of us to participate in the market, and then pair that with access to education and other support through community programs that we do, really to help encourage and empower people to participate in ways in which they never have before, because unequivocally, investment in the stock market is the most powerful wealth building tool that we have in this country. And more people need to participate in that to help accelerate the growth of their wealth and create agency to drive their own outcomes.
Great. Stacy.
Thank you. So we are also looking at pathways to equity ownership for folks, working class and folks of color in particular. And that is really important because in our society today, just having even a solid W-2 job does not necessarily give you enough income for emergencies, let alone does it give you enough income to have a retirement or generational wealth. What is required is equity in something, and that's what we're here talking about, and traditionally that is real estate, and what we are looking at is equity in the workplace where you're already spending 40 hours a week, sometimes more, sometimes less. If you're already there contributing at that kind of level, your intellectual, physical, and emotional labor, then why not have a stake in that and have that equity stake help drive your wealth over time, not only for that income security for emergencies, day to day, week to week, month to month, but also to build a retirement and potentially generational wealth to be passing on. So in our country, that's very uncommon. I live out here in the Bay Area. It's quite common now in the tech sector for there to be some equity attached to your W-2 job. Unfortunately, that is most often being offered to folks who have college degrees, maybe graduate degrees, et cetera, et cetera. That's not necessarily a pathway that's available for working class folks who are getting paid hourly, et cetera. So we want to address that, and we can. So taken together with the fact that about 3 million businesses in this country are owned by folks over the age of 55, and most of those are very small businesses. And those businesses don't have a pathway for succession. Many of those small business owners they don't know what, or they plan to pass it to a child who many times will not want it, or they have a hope that they will be able to sell it to someone else. And unfortunately, we see less than 50% of those small businesses actually accessing that kind of succession, leaving at least half of those 3 million businesses at risk of shutting down, and all of those jobs and all of those very important pieces of a value chain are lost. And so we look at employee ownership as a way to address that at the same time as we are bringing these wealth building opportunities. So employee ownership is the solution. And employee ownership we talk about refers to broad-based employee ownership. This is not just stock options for the select few in the organizations. It's not a management buyout where 2, 3, even 4 of the key employees are going to go get funding to buy out the owners. This is broad-based, so every employee in the company has access to this equity ownership play. In the United States, we have 3 common forms of employee ownership. The first many might have heard of is an employee stock ownership plan, an ESOP. That is actually a retirement plan, and it's a retirement plan invested in the stock of that business. It is a phenomenal wealth-building engine for those folks because it's putting that money directly into a retirement plan, and folks are not paying for that. They don't have to buy that equity. But we also have tools that can be used for smaller businesses. We have a worker-owned cooperative, which has been in the Internal Revenue Code and the corporate code in this country for a long time. It can bring tax benefits to the selling owners. It's a great model for smaller sized businesses where it's a participatory democratic governance structure, 1 share, 1 vote in the business. And more recently, we are starting to use something called an employee ownership trust, which is a model that's built on a trust framework called a perpetual purpose trust. It's been used in Europe, particularly the UK, for decades to great effect, and we're now starting to use that in this country. So we have an employee ownership model that will fit most businesses out there. The right model exists. It's not a one-size-fits-all. And the community focused on employee ownership is looking for new models all the time and innovations that can make it easier, less friction, easier to finance. These are leveraged buyouts, and so that's the other key thing that I'll just wrap with, is that the employees are not going and using their own money to buy this asset. That is not happening. These assets are funded through capital. Impact capital, CDFIs, in some cases banks, and in many cases also a seller note. So that seller who's selling the business is also going to put up a note for a portion of that sale price, and the business is going to pay off that leverage or equity over time out of its operating profits. Only in a worker cooperative do we have the situation where folks will pay a nominal buy-in for that. But in an ESOP or an EOT, that's not the case. It's gifted to the employees. And that is a huge differentiating factor here. So folks are not having to go put up a personal guarantee or go find the funding to do this out of their own pocket.
At GROW, we're trying to solve for poverty and the racial wealth gap, or the racial wealth divide. We believe these 2 problems are inherently linked, and that we need to solve, that solving for one requires solving for both. In particular, I think Sarah started with some of these statistics. The racial wealth divide nationally is 1 to black-white. Racial wealth divide nationally is 1 to 8. In Atlanta, and in many other cities across the country, it is much higher. In Atlanta specifically, the racial wealth divide is 1 to 46. I think sometimes we hear these statistics and we know it's bad. It is unconscionably bad. It is as wide as it was when the Emancipation Proclamation was issued in 1862. Certainly the floor has been raised on sort of economic well-being, but the divide itself continues to persist despite about 150 years of public policy. It has not been meaningfully narrowed nationally, that 1 to 8, really since shortly after the Civil Rights era and the legislation after the 1960s. One of the primary reasons for this is that wealth begets wealth. So the wealth is very simply a function of yesterday's wealth, so yesterday's historic public policy that enabled certain communities to accumulate wealth, protected that wealth, and saw that wealth appreciate over time, plus any excess income that you're able to save to accumulate wealth. So these sort of income and wealth conversations we believe are really inherently linked, because it's really difficult to build wealth if you don't have proper income and you're constantly pulling from what would be wealth to meet basic needs or sort of basic consumption on a day-to-day basis, aka income. Conversely, you need income sufficient to be contributing to your wealth if you don't come from a community that already continuously has that. And so what we're really looking to solve for are what are the root cause solutions to address that racial wealth divide. If yesterday's wealth is a key input for today's wealth, how do we actually help communities that haven't, because of public policy over centuries, but also the past couple of decades, have really been kept out? How do we get, if a rising tide can lift all boats, how do we get folks to have a boat in the water to begin with is really what we're trying to solve for. And then how do we protect that boat so they aren't, drawing from it continuously to meet their basic day-to-day needs. So we really think about these income and wealth conversations together. Our goal as an organization is to bring some of these most promising solutions that we know have an outsized impact on closing the racial wealth divide and wealth inequality broadly to life and to scale. Through public policy, and we really run pilot programs to that end. So I know we'll get into solutions in just a second, but that's kind of what we're looking to solve for.
So let's get into it.
Okay.
So tell us a little bit. I know Hope with the Grow Fund started with a basic income program, universal basic income program, and now is launching an accelerated baby bonds program. So tell us a little bit more details about what each of those projects are doing.
Yep, happy to. And I know some folks in the room might be very familiar with both of these policies, maybe some folks less so I'll just kind of start with the basics. Grow started by talking to people in communities about what they needed to be economically secure. We started in Atlanta, Georgia, in Dr. King's neighborhood, one of the neighborhoods, the Old Fourth Ward, one of the neighborhoods that is the most unequal in the city of Atlanta today. So you have the largest concentration of Section 8 housing, just blocks away from massive multi-billion-dollar developments. And Atlanta is really a booming city, but what we have found is that despite this perception of sort of success and sort of racial equity in a city too busy to hate, really for the past 4 decades, 1/4 of Black residents have lived under the federal poverty line. So we're missing something. Something about our approaches is missing. So in talking to residents, we asked what would help them get to the next stage of their economic stability, but also, importantly, economic mobility. And what we heard is that it just simply doesn't add up, especially for Black women in the community. Black women make 63 cents on the dollar compared to their white male counterparts, and they're the most likely group of women to be working, despite sort of some misconceptions sometimes about folks' labor force participation, and yet they're the most likely group to live in poverty. So they're working, but they live in poverty. Make it make sense. It just simply doesn't add up. And so we initially started with a guaranteed income program to help provide just some of that income floor that is a necessary prerequisite to wealth building. It alone is not sufficient, but it is a necessary prerequisite. We were able to launch the In Her Hands Guaranteed Income Initiative. It's a $30 million project that supports over 900 women across the state of Georgia, spanning rural and urban Georgia. And we provide a 2 to 3 year guaranteed income, and we study the outcomes to better learn how public policy can help to implement a robust social safety net where all of us have some type of income or financial floor to rely on. But that alone is not sufficient for communities to thrive. Income is great. Sort of an income floor might be a great idea. But in order for communities to truly thrive, they need access to investable sums that will appreciate over time. And so this is where the concept of a baby bond comes in. A baby bond, very simply, at its policy level, it's not quite a bond, but at its policy level, would provide young people at birth with a sum that is automatically at birth, if through a federal program, would provide young people a sum that is invested over time and at maturation at 18 or 21 years, that young person is able to draw down this sum for wealth building purposes. Really specifically, Senator Booker and Representative Ayanna Pressley have proposed a bill that would invest $1,000 at birth, and then automatic, universal, everyone gets $1,000 at birth, and then $2,000, up to $2,000 a year, depending on family household income, so it's progressive, so that young people, when they turn 18, presumably, are on average receiving about $40,000 each. This is to spend on wealth building purposes, buying a home, higher education, starting a business, investing in the market possibly, that's under discussion right now, you name it. So these are solutions, guaranteed income, baby bonds, these are solutions that can have an outsized impact, very modest cost on these proposals too, really have an outsized impact on closing wealth divide generally, but also the racial wealth divide. The baby bonds proposal would narrow the racial wealth divide by about a fourth, so about 25% estimates show. For a single intervention, that is remarkable. Senator Booker's bill costs about $82 billion a year. So this is a really reasonable price tag for an incredibly outsized solution, for a solution that has a really outsized impact on these issues, and that also helps to grow the pie. It's not necessarily a zero sum. It helps to grow our economy more broadly. You have more people in the market starting businesses, entrepreneurship, more home ownership. These are things that help to grow the pie overall for all of us. So our work really at GROW is to bring these solutions to life through pilot programs. We have the In Her Hands program, and then we're launching an accelerated baby bonds pilot program that will be a 6-year program that will enroll late teens, early 20s adults. We'll provide them a guaranteed income of $500 a month, and then we'll provide them $40,000 in a baby bond to spend on wealth building purposes. And we'll be generating learnings relevant to this federal and state policy conversation on what sort of investable sums for young people could look like that I think is gaining tremendous momentum in the next couple of years.
Great, and I'll just stress what Hope was talking about on this accelerated baby bonds program. You know, there's a lot of states who are looking at these kind of programs, and it would be a mix of public and private dollars, but we won't know the impacts for another 18 years, right, because these young people won't get access to it. So this accelerated baby bonds program is going to expedite the learning process, and that's why we're so excited about it, to really see in 3 years' time what will the young people leverage those dollars for, what will their wealth building pathways look like beyond that point that will inform local, state, and federal policy going forward. So Stacy, before we get to the challenges, before that, I will make a PSA ad if you want to write any of your questions down. I've already got 2. But Stacy, before we get to the challenges around employee ownership, can you talk about some of the positive impacts that you're seeing with businesses that have converted to employee ownership models, and any like individual stories of employee owners?
I would love to. So we, Project Equity is celebrating its 10th anniversary, which is thrilling. We have one of our co-founders is in the room here, Allison Lynn Gain. And we're so proud of the work over the arc of this 10 years, and we just have published a bunch of data based on the first 10 years of our work. Part of our work is to find businesses and help bring them through the employee ownership journey, converting that business, transitioning that business from private ownership to employee ownership. And we track the performance then of those businesses that have made that transition, and we look at things like quality jobs factors. What is the pay rate? Is it going up? What is the governance structure looking? What does the participation look like? What is the profit sharing that is being done over time? So the results, even just from our small portfolio, are fantastic. And when you look at all of the results of employee ownership transitions, it's even more stunning. So just in our portfolio alone, the businesses that we've transitioned since 2018, they've paid out $1.7 million in patronage or profit sharing. And that's to about, I think, a little under 200 workers total. We've also seen wages grow on average in those businesses by 30% since their conversion to employee ownership. So they're significantly outpacing their peers in the ability to pay more and to bring just the basic W-2 income up. And that's in addition to the employee ownership, the profit sharing that they're having. If you look more broadly at the statistics, particularly when you look at ESOPs, employee stock ownership plans, which is not something that Project Equity does directly, we work through partners to do that, the results are even more significant. I don't have the specific numbers, but the number of millionaires who have been made through ESOP participation since about the 1980s, when that particular mechanism was developed, is very, very significant. And that is really life-changing. We have a few stories just in our portfolio that have had life-changing moments. So we have a woman who was working part-time in a bakery in California, single mom, and when the transition of, it was a very small bakery. I think they had 7 employees at the time that we transitioned them. So these models work for very small companies. When she was able to go to a bank and secure a mortgage loan for a house and buy a house, something she never imagined she would ever be able to do. But because of her ownership of the business in a cooperative model, the bank was able to look at her differently than they were able to before. And so that was really life-changing for her and for her children at the time. So.
Great. And with any company, whether you're small or large, everybody's looking for increased productivity, increased employee satisfaction and retention, and research has proven that all of those things happen in employee-owned businesses. But I'm going to turn to Trevor next. Trevor and I have had a lot of conversations about the fact that what his platform is doing is not democratizing access to capital markets. That's already happened. But what's unique about your product? Why is it so necessary that it's specifically targeting communities of color? And what have been some of the impacts? Because we've worked on a few projects together.
Sure. So I completely agree with what Sarah said there. So investment products, investing in the financial markets is a completely commoditized process, right? And what gets missed oftentimes along the way is, why are people in underrepresented Black and brown communities not investing in the markets if it's as simple as going to the App Store and downloading an app, or opening an account online somewhere? And I think really what it comes down to is a lack of representation, or a lack of confidence that you can actually participate in this space. And so one of the things that my team and Sarah's team have been working on is that we have developed these novel seed investment and financial wellness education programs, where we pair access to starter capital to help get people started in the markets. So it reduces the angst and anxiety that people have about putting their own capital at risk. We also, as I said, pair that with education, so helping people understand how the markets actually work, demystifying some of the terms, helping people understand that day-to-day, week-to-week, month-to-month volatility actually doesn't really matter. Just giving them a space in which they can, again, be more comfortable and confident in this process. Alongside of the team at Prudential, we have done this with HBCU students across the country. We have also done this with small business owners in Detroit, because we see intersectionality between personal financial wellness and business financial wellness of Black and brown small business owners, and thinking about what are the ways in which we can actually get them access to more capital to help scale the growth and impact of their businesses. So through those programs, in addition to the 2 that I just mentioned, we have also done some work in cities like New Orleans, where we are working with low to moderate income families, those that are living above the federal poverty level, but still don't make enough money to meet basic necessities of life. And so the point is, like, across audiences that I think all of us care about, there's an application for increasing participation in the financial markets to help bring about positive and impactful change. There's one stat that I share all the time. If you did nothing more than invest $1 a day, so $30 a month, and you got the average market rate of return that the S&P 500 has produced over the last 30 years, which is about 10.5% before adjusting for inflation, at the end of that period, you'd have nearly 2 times more wealth than the median Black family has in this country today. So it can be that simple. The challenge, though, is how do you get people catalyzed to start to participate? And through these programs, what we have seen is that the increases in confidence, the increases in the belief that the investment process is for you, have all increased in profound ways. Nearly 50% of people start to believe that the investment process is for them. Those individuals that come through our programs, nearly 90% of them do start to invest in the market. Once they get started, 99% of them remain. We see significant impacts on fundamental aspects of financial wellness. So having security to meet emergency risks or financial shocks, a reduction in stress and anxiety related to just your financial position. One of the areas that I am most proud of in our work, being the father of 2 daughters, is that we all talk about the lack of confidence and participation in the financial markets by women across races in this country. What we have seen through our programs is a 3x increase in the confidence and willingness to participate by women, a 4x increase in their comfort with making investment decisions in the markets. So again, regardless of the communities and types of people that we are talking about impacting, we know that investment in the financial markets is a extremely powerful tool when it comes to building more wealth. And the thing that I personally like about investment in the markets, maybe two things, is one, unlike other financial products, the financial markets are inherently fair. So if I go and open up a brokerage account, or Hope goes and opens up a brokerage account, we're going to get the exact same rate of return just by showing up and participating. So you don't have the issues and concerns of unconscious or conscious bias that have historically existed in the financial process for many people. The other thing is when you think about the capital intensivity of this intervention, so in the programs that we did with the team at Prudential, we gave 500 HBCU students $1,000 each. Right, and compare that to possibly programs like down payment assistance to buy a home or things of that nature. The cost to get people started and activated in this process is significantly lower. The return on impact and performance comes much quicker. So we feel very strongly about the work that we're doing and are looking to continue to partner and expand the impact of this work in other communities across the country.
I'll say the reason why we've been seeding these investment accounts, I don't know about the rest of you, but I didn't invest in a 401k account when I got my first job because I didn't know anything about the stock market. I didn't have any confidence in investing in the stock market. I didn't know anything about building an investor identity. And as Trevor mentioned in all these stats, I mean, stock market returns has appreciated 5 times more than home ownership returns. And so seeding these kind of investment accounts, whether it's early on in life or, with small business employers and workers, is helping them seed that pathway and building that, point of building wealth through the stock market. So one more question, and then I'll get to all these questions that I got here. What are some of the biases that you guys have each faced, whether it was personally as leading this work or around your particular solution?
I can start. So when I first founded the company about 4.5, 5 years ago, the immediate question to me was, well, why do you need a solution for Black people? There's plenty of other investment platforms out there. Why can't they use those? And I think that fundamentally misses the point and does not acknowledge the lack of representation that exists in this space. It also misses a very fundamental understanding of the demographic shifts that are taking place in our country. Whether you believe in Stackwell, in the investment process, or any of the work that any of us are doing, what is unequivocally true is that we are going to be a majority-minority country in the not-too-distant future, so all financial services firms, and frankly, all consumer-facing companies are going to have to figure out how to engage and build trust in an authentic and intentional way with the audiences of people that we are all trying to serve. All right, and so that's why there's a need for this work. In addition to that, let's just be very clear about it. I, as a Black founder and as a leader of a company that is focused on inherently Black and brown issues, the bar is higher for me. It just fundamentally is, and that's okay. I'm not asking for it to be easy, but when it comes to accessing capital to grow and scale the impact of the work, the performance metrics that were required for me, the sort of state and extent to where the business needed to be to get access to capital was far beyond anything that you would expect at a seed or Series A stage as I was continuing to try to get the business off the ground. And I think for me, yesterday during the plenary session, Anthony Bug-Levine was talking about the gap between intention and action. So I oftentimes find myself in spaces like this, in these conferences, and we're talking about getting access to Black and brown founders or talking about trying to find evidence-based solutions that can actually scale the impact and closure of wealth gaps that persist across the country. But I find myself kind of like hiding in plain sight, because here I am, someone that has 20 years of professional experience doing this work and has the evidence behind the solution, not only empirically from the financial performance of the markets, but the evidence of our work. And we still can't get the access to capital that we need to actually scale and do the things that people in these audiences say that they want to do. So that's the challenge, and we need to solve for that.
Thanks. Tough act to follow. There's some different ways that I can answer this question. So in terms of biases, in the field of employee ownership, one of the biggest challenges that we have is awareness. Nobody knows that this is a possibility. Very few people understand that there is a built-in buyer for every business, and that buyer is the current employees and future employees, and that we have the mechanisms to do that. One of the biases that we face is, even for some of the selling owners who we work with, their doubt that the employees can really take the business forward and provide the leadership and the critical thinking skills and really the grit and sometimes the long hours that they have done, the entrepreneur has done. And we see repeatedly as we do these transactions that the light bulbs that go on in people's heads when they are suddenly presented with an opportunity to take on a much different role in their day-to-day job than they ever imagined for themselves. These are folks who may have never gone to college, certainly didn't dream of being business owners themselves. And so for us, identifying those stories, uplifting those stories, and in our daily conversations with selling owners, helping them to understand that that is possible in their workforce as well. One of the other things that is challenging is we have a private sector solution, and there are sometimes biases that those employees should be paying for the business, that they should, or that we should be generating very strategic returns on doing these deals. And that is a challenge because really finding the kind of capital that we need and accessing enough of the capital that we need that is not looking at extractive returns, but really looking at reasonable and in some cases concessionary returns is really critical. Because what we are doing, again, just as everyone here is talking about, is really uplifting folks who didn't have a chance to start with a pool of equity that they are now trying to enhance. We're working with folks who are low to moderate income, folks of color who are frontline workers, and they haven't had those opportunities. And so we have to also be bringing the capital, the right structure of the capital to these deals. Again, these are leveraged buyouts, either through debt or equity. So those are some of the things that we're dealing with in the marketplace.
Some of the biases, I think one major bias that we face is our programs at the Grow Fund are primarily focused on Black communities. Certainly public policy at scale probably is universal on some of these solutions, but we really deeply believe that in this iteration innovation phase, it is incredibly important that we are building solutions for those who are most economically marginalized, and when we do that, we're creating them in inclusive and equitable ways to bring them to scale. All of these public policies that I've discussed in our pilot programs, if at scale, they can certainly help to narrow racial disparities, but they could also widen racial disparities. And sometimes that's a difference between, are they automatic? Are they universal? There are different things. What's the deposit amount? These are the types of policy decisions that actually can determine whether a solution is bridging disparities or widening disparities. And so we really believe, and we get this question a lot, why focus on Black communities sort of first? Why in this innovation iteration space do that? And it's really because we believe that's how you build equitable policy from the ground up, and you do that with communities. I would echo a lot of what Trevor shared about being a Black founder. Many of the same trends that we see in the VC space carry over to nonprofit founders, and sometimes no matter how much experience you have, it can still, folks can be reticent towards some of these solutions. And so, in particular, I think a lot about sort of some of our solutions, the importance of this sort of iteration phase of our baby bonds pilot program. Will be the first baby bonds program in the country to return learnings. That's in about 3 years when we launch in April, and we're still raising money for that program. Fully built out, we're hopeful it'll reach about 250 young people, but we're launching an initial cohort next year of 50 young people. And so many of these trends persist, and so this alignment between commitment and action is one that certainly permeates.
Thank you all for sharing that. I'm going to go through some of the questions. So, Hope, I'm going to start with you. What are the stipulations for being part of the pilot Baby Bonds program?
Terrific, yes. For our initial cohort in this 6-year accelerated baby bonds pilot program, we'll be focusing on one neighborhood in Atlanta to start with. We're meeting with the city to finalize that neighborhood in the next couple of days. And then there'll be an income threshold, so the family household income needs to be about 2 times or below the federal poverty line. And then young people need to be ages 15 to 24 at point of enrollment. They'll have 3 years to plan how they're going to use the baby bond. This is a really important component of the program, and what we've seen from other previous programs like CSAs, the planning stage is really important. So folks will have 3 years to plan how they're going to use the funds. They'll have financial advisors, wraparound services, and then they'll start to draw down that $40,000 baby bond around year 3 in the program. So that's some of the eligibility criteria.
Thank you. Okay, Stacy, this is a 2-part question because I'm combining 2 different parts. Is there an employee ownership structure trust example that a large nonprofit can explore? And then with that, there was a recent Wall Street Journal article about HVAC and plumbing companies being bought by private equity firms. How do we increase the awareness of employee ownership among business owners so they think of this first?
Okay. Let me take the first one. Nonprofits have a legal ownership structure in this country, and they are not owned. They function with grant dollars and are not participating in that ownership equity piece. However, there are many forms of democratic governance in a nonprofit, so that the employee voice is a critical component of employee ownership, so that employee voice and that participation can absolutely be manifested in a nonprofit. But since a nonprofit doesn't have an equity ownership structure in the first place, we don't see that being used there. So the second question is a great question. So in the employee ownership space, we talk about 3 critical hurdles to employee ownership really scaling as a common mechanism in our economy. The first is awareness. Folks just don't know about it, so let me come back to that because that's really the question here. The second is the inherent friction in M&A transactions. So getting any business sale done is difficult and challenging. Getting one done in the employee ownership space has some unique friction points as well. And then finally, the third that we always talk about is capital. And do we have the capital that we need? Can we structure the capital the way we need to? So coming back to the awareness piece and the question about HVAC. So project equity, a lot of what we do is raising awareness, and there are a lot of different ways to do that. So one of the key things is storytelling and being able to tell stories. And those stories then can go viral. And the hope is that business owners start to see themselves and their business and their legacy in those stories. And the light bulb goes on. Another way we're addressing awareness is by engaging service providers. And so small business owners have trusted advisors. They might have a CPA, they might have an attorney, they might have a banker, they might have an insurance broker. all of them are trusted and have helped them on this journey that they have built this company through. And those trusted voices are often the first place that folks are going when they say, I need to retire, or hey, my spouse is going to leave me if I don't sell this business quickly and get out of it. So they're going to those sources, but historically, those advisors haven't understood what employee ownership is, and in the worst case scenario, they have said, that's a terrible idea. You should definitely not sell your business to your employees. So we're working very hard to stop that. We have a program where we have 10 modules that are continuing education certified for CPAs, for certified financial planners, for exit planners, so that they start to gain the knowledge, they start to understand the proof points, they start to understand the mechanisms by which employee ownership can be done to build their confidence so that when their clients are coming to them looking for solutions, they are that first stop and they know what they are talking about and they are bringing that solution to them. The third one that I'll talk about in terms of awareness is we have strategic partnerships with many municipalities throughout the country, particularly in areas where there is a high density and high incidence of Black and Latino workers. And our partnerships in those locations are meant to work with the economic development and workforce development folks in those communities to teach them, again, about employee ownership so that they are looking at their policies, their practices. They are conveners of the right folks in the community to start to elevate employee ownership as a critical strategy, because in those localities, if those businesses are closing, if those jobs are leaving, it's leaving a hole in the economy that's really important to address. So again, they're another critical stakeholder that we need to educate and who need to be on the front line of raising awareness about this. I can go on because we've mapped all the critical stakeholders who all have to become aware of it. Those are just some of them.
Great. Trevor, how would you describe your core client from a socioeconomic lens? Is there a space at Stackwell for low-income clients? Can you say more about how you manage risk in stock market investing?
Sure. So yes, there is a space for low to moderate income individuals to participate and utilize the Stackwell platform. I would say the ideal customer kind of runs the gamut, which is obviously not a great thing to say to an investor audience, but the reality is, like, the issue that we're trying to solve for is pervasive across the age, income, and education spectrum in the communities that we're trying to serve. So it doesn't matter if you make a bunch of money, you probably still don't have the confidence to invest in the market because of just historical, social, emotional, and cultural issues. So understanding that there's a space for everyone in this process. But to go back to the point about low to moderate income families, one of the things that we tried to do at the outset of developing the company is ensuring that it was accessible from an income perspective. So we can get people into the markets with as little as $10 a month. And we then deploy that capital through use of our model investment portfolios, which gets to the second part of the question about risk. The reality is that investing in the markets is not actually risky if you do it in the right way. So we know that trying to go out and pick individual names is not a worthwhile proposition. We know that broadly diversifying your assets across a portfolio of securities is the best way to participate. I already shared earlier what the performance historically has been in the markets. And so if you can help address some of the emotions associated with the process, if you can help people understand that if we're experiencing moments of volatility, that is actually, in fact, not the time to take your money out of the market, but possibly maybe the time to double down. We really are focused at Stackwell on trying to help people understand the long-term value proposition of being a long-term buy and hold investor. So if that's the way that you're participating and you're not chasing trends, you're not trying to buy individual names, you're not investing in crypto, those types of things, you're probably going to be in a situation where you can sustainably invest in the markets and build your wealth over time.
I'll just add with the HBCU program that we're working on with Trevor, the majority of HBCUs, not the majority, a large percentage of HBCU students are unfortunately on Pell Grants, and we even had a situation where, a student had expenses that they need to pay that were a little over $500, and that was going to cause them to drop out. So, you'll hear college presidents say all the time, one of the best success factors in helping students persist is just having $500 in their drawer so that they can help a student. So, Stackwell's program is across all income levels. One of the questions that I did want to get to that, because this room is a mix of impact investors, philanthropy, people who are working in the field, what is the role of impact investing in each of your bodies of work? Some of you actually have funds or you're raising funds, but others, especially Pope with the Grow Fund, how does that interplay? So whoever wants to start.
Terrific. I'm happy to start. We're a nonprofit, but we are, depending on the type of impact, if it's social impact you're looking for, we are certainly fundraising to launch that baby bonds program as I described. And then for folks here in this room, I think a lot about, if baby bonds is adopted by states, it already is adopted by a couple of states, including Connecticut, but federally as well. What types of products and services will these young people be using that can help to maximize that investable sum that they're receiving? We have at this point sort of an 18-year time horizon, maybe a little bit shorter, maybe closer to 15 years, where we have this window to be thinking about what are those products and services that are built in a way that is equitable, that help them to make the most of that investable sum that they're receiving. And so I think a lot about this room, and that many of those ideas are likely going to come from folks at this very conference or in this very room on how we can maximize these solutions for equitable impact.
Well, Project Equity is also a nonprofit 501c3, and we rely on philanthropy to help fund innovation, to subsidize some of our work in the private sector, as well as to help us drive awareness raising, which is an expensive proposition. And we do things like we have we're the host of something called EO Equals, Employee Ownership Equals, which is a website nationally that really promotes employee ownership and helps explain it, breaks it down into its components. But we also have an impact fund ourselves, and we have two capital initiatives. So one is an impact fund, the other is something that we run together with a CDFI called Shared Capital Cooperative. And in that impact fund, that is a fund that we are raising. It will ultimately be a $20 million fund. And that fund is providing patient flexible capital that we can bring to these transactions, again, in the form of either debt or equity, providing concessionary returns to the impact investors. It's incredibly important. So mainstream banks are not there yet. They don't understand the idea of lending money without a personal guarantee. That is sort of anathema. Now we're working really hard with the Small Business Association to try to get 7A loans to accommodate these kinds of things. It is a long path. It is a long path to work through the policies and the bureaucracy on that. So in the interim, impact funds are critical to employee ownership, and us being able in the early days of this work, which we are still in many ways, to be able to demonstrate and have these proof points. So the more that we are lending out of our impact funds and out of the other employee ownership impact funds, and seeing these borrowers pay back on time and in some cases ahead of schedule, those are proof points that we need to go into the mainstream capital markets and attract more dollars there. We also use our impact fund, which is called the Employee Ownership Catalyst Fund. We also use that to co-lend and de-risk, bringing a more mainstream lender into a deal. We also use it to participate in deals, again, being able to de-risk some of these deals. So we are really trying to not only do these transactions and have enough capital in the marketplace to do them, we are also trying to provide the proof points so that we ultimately can bring mainstream capital to the table as well.
I think there's two ways for us in which impact investors, foundations, philanthropists can engage in our work. The first is to seed programs like the ones that we've done with Prudential, so helping us to scale the impact of that work. The program that I mentioned with Sarah, Prudential graciously put up $1 million, but we have evidence now, and we know that it works. And instead of raising $1 million, we need $5 million or $10 million to expand the reach of these programs. And so the thing that we are focused on right now is how can we partner with some of these organizations to get that type of capital in the door to, again, deploy it to more people, help impact confidence, behavioral change, all of the things that are required to get more people into this process. The other piece of it, so Stackwell is a for-profit company. We have raised a number of rounds of venture capital. When you look at just changes or impacting performance from pre-seed to seed to the Series A that we did earlier this year, we have produced market rates of return at every stage of the process, right? So this does not have to be concessionary. And I think that there's really interesting and unique opportunities to possibly pair investment in the business with investment in the work that we are doing in the form of grant funding to really put a thumb on the scale of the impact that we are having, but also drive stability and performance of the company.
So I got the notice that we only have like 2 minutes left, so I'm going to ask one last question. So one sentence each. What does an ownership economy mean for each of you?
To me, it means agency, it means freedom, it means the power to shape and direct your own outcomes.
Yeah, I really think it means freedom. I mean, it means freedom to participate in all the different ways that we have available to us and the means and confidence with which to do that. And one sentence.
Very similar: choice, agency, self-determination for individuals and communities.